Hi, welcome back to Academic Market Insights. I'm Dr. Russell Rhodes, joined by Dr. Larissa Adamiec. Today, Dr. A, continuing on with her series about personal finance. I think one of the major goals, probably the number one goal of a lot of people, personal finance wise, especially my age, is what's going to happen at retirement. And there are various ways that you save for retirement, and part of it has to do with where you work and even what industry you're in. So, Dr. A is going to break that down, qualified versus non qualified plans. But we're also going to spend a couple of minutes and look at it from the employer standpoint. What are the pros and cons behind the different retirement plans that you can offer your employees? So, with that, I'm going to hand things off to Dr. A and interject when needed.
Thank you, Dr. Rowe. I'm excited about this because it's such an interesting topic, and it's something that's so important, and it's something that I feel like we don't really give a whole lot of deep thought until we're at retirement. But your company has lots of different opportunities or choices to get you ready for retirement. And remember, when we think about these retirement plans, this is a form of compensation for you. And again, going back to our first video in this series, employers want to compensate you, and because they want to attract the best talent. And as an employee, we're interested in these compensation packages because not only do we want cash in our pocket today, but we want to be set up for where we're going to be for retirement. And governments care very much about retirement plans because of the implications of taxation, as well as making sure society is ready for retirement for those who do retire. The government genuinely is interested in making sure that everybody is self-sufficient. Okay, so we're going to be talking about qualified plans that are under the Internal Revenue Code 401A. We'll talk about some of the benefits of them, and we will talk about some of the pros and the cons. But this again is under Internal Revenue Code 401A. Uh, Never thought get so nitty gritty in this. I know we've discussed previously in other videos and other series different legislation and impact on the financial markets. Well, some of these tax codes have a huge impact on how we are going to be setting up things for our own personal retirement and our own personal finance. So we're going to talk about pension plans, profit sharing plans. We're going to dive a little bit deeper between defined benefit and defined contribution. Although defined benefit is going on the wayside, there are still companies that have defined benefit opportunities out there. More of them are in the government sector. And that gets back to Dr. Rowe's point that different industries, different types of positions are going to have different types of retirement plans. And again, when you're as an employee looking at this, you want them to be a qualified plan so that you can get some of the protection from ERISA and those tax benefits, which is why we care so much about Internal Revenue Code 401A. So again, let's look at our pension types. We're going to look at defined benefit, cash balance, money purchase plans, and finally, our target benefit pension plans. So these are just different types of pensions that employers have the ability to offer to employees. And let's talk a little bit about, again, what a pension plan is. This is the idea that the company is going to be paying out a salary, a portion of your salary for the next set number of years of your life, usually until you pass on. Some of these plans not only pay out until you pass on, but will pay out until you and your spouse passes on. So there's lots of things to really take a look at. So for profit sharing, and profit sharing could be your 401k plans. You can put stock options in there. So I want to briefly mention the stock bonus plans because this is something Dr. Rowe and I have had a little more experience discussing and thinking about in corporate finance. We like stock bonus plans because that helps align agents with the owners of the firm. So if you think of an owner as the shareholder or a shareholder as the owner of the firm, one way to reduce any friction between the agency or the manager of that firm is to align that compensation. And so, a unique benefit, even within our profit sharing plan, of putting those types of products in there is it helps eliminate and motivates employees to do what's right for shareholders. We could look at age-based profit sharing plans, but again, in my opinion, and again, this is my opinion based on literature in the corporate finance arena, those stock bonus plans are very valuable to helping align those interests. Okay, so let's talk a little bit about some of the differences between a pension and a profit sharing plan. I think most of us, or at least Dr. Rowe and I, have a little more experience with pension plans and the fundamentals of what they are. And the promise is you're going to be paying out that pension until the end of your life or the end of your spouse's life. In a profit sharing, you get a deferral of compensation in taxation. So you're not going to be receiving those benefits immediately, but rather at the time of fund withdrawals within the disbursement phase of your life. Okay. So you're going to have withdrawals for your profit sharing, um, mandatory funding, and this is something that has come up quite a bit, is this idea of that the firm is going to make sure that there is enough money within the system or the account so that everybody can have their pension paid out. And it's a legal requirement. This is why it's a legal promise that you are going to be paid that pension. Versus a profit sharing, the firm is not legally responsible for making sure that there's enough funding for you to have that in the future. Yes, Dr. Rowe.
I was just going to say the survivor annuity, that doesn't mean that your surviving spouse loses it, does it? It just means that there's not an obligation to make sure they keep receiving payments.
Correct.
Am I
This is
stating that
not
correctly? Okay, that's what I
Yeah,
thought.
not legal obligation, but versus in a pension.
Mhm.
And I've seen some pensions do half of the amount, some do full.
Huh.
It's unique. I remember I want to say my grandfather retired at 60 and lived until 94, and then my grandmother lived another 6 years afterwards. So the company ended up paying 40 years worth of pension
Wow.
to him, which is again, from
Unbelievable. Yeah.
our standpoint in 2025, it just feels unheard of. In our
Yeah.
next video, we'll be talking about the formulas for how do you calculate how much money that is going to be for every year. But when
Mhm.
you start to think about this, and that's why this mandatory funding is so critical. If you know that you're going to be paying a certain amount for an employee, you need to make sure that there's enough money within that account so that you can actually do that.
Absolutely.
Defined benefit versus defined contribution. And defined benefit is what we can think about, or traditionally, I personally have thought about defined benefit as our pension plans and defined contributions more as our 401k plans. Dr. O, is that kind of how
Mhm.
you also see it? Yeah.
Absolutely. Absolutely.
Um,
Yep.
so defined benefit, this is again why this is a legal contract in our pension plan. It's going to be very spelled out within the contract itself of how much is going to be put in there versus an annual limit of 25% of the employee salary is going to be allowed for the contribution, and that'll be combined of both the employer and the employee. The risk for defined benefits is really focused on the employer. And that risk comes from making sure that there is enough available funds for distribution. So if you are having an employee that's maybe 30 years old, you need to be investing a certain amount every year and hopefully managing those investments so that they can grow with that salary and grow with the ability to support other employees versus in defined contribution, we as individuals will make the decision of how those assets are going to be invested. So in defined benefit, we don't make those decisions. The employer makes the decisions of how those investments are going to be handled. Now, I know we've picked on, well, I'm drawing a blank on it, the California Teachers Association.
CalPERS. Yeah,
CalPERS.
CalPERS, California Pension Retirement System.
Perfect.
Yeah, and they they offer defined benefit, which a lot of government employee funds around the country do. Living in Illinois, we are, we're both aware that the state of Illinois has a big old shortfall with respect to what they have promised to pay people in retirement. Um, but the defined benefit plan, one of the biggest risks is to the employer. They promise to pay a certain amount of money out to their employees upon retirement, and they've got to put money away and they've got to invest wisely so that they have uh, they have the capital on hand to make payments to their retirees, and they don't want to be drawing from current profits to pay out retirees. So and I believe they're supposed to have that money set aside on a present value basis.
Yes, they're supposed
Yeah.
to, and again, those rules were changed in the early 2000s. So that wasn't always the case. And those reason those rules were put into place is because this is a legal contract. If for some reason the state of Illinois doesn't pay those benefits, those people have the opportunity and availability to sue the state of Illinois, and they would win.
Hmm.
This is a very defined contract. State of Illinois would be in breach of the contract, and those employees or retired employees would be able to successfully win. Now, there's a old adage that if you are suing somebody but they have no money to pay you, does it really matter? There
Hmm.
would be ways to actually go about it. And to Dr. Rowe's point, for a corporation, what they would do is simply to eat into the profits. The state of Illinois might raise taxes to be able to pay for that and other things, which
I
would,
mean, that's what they're going to have to do.
yeah,
I
eventually
mean,
it's
and the city of Chicago is on the hook for some pensions as well, and the mayor of Chicago has already said they're going to have to they got to raise capital one way or another. And I 5 years ago I saw a presentation from the person who runs the city of Chicago's pension fund, and she outright said we're not going to be able to cover our obligations unless we get some sort of cash infusion. That was 5 years ago.
sure.
I doubt that it has gotten any better.
No, I completely agree with you. So some of the advantage of these plans is the taxation of contributions, URSA protection. So there's legislation that protects individuals and employers. Okay, this is both an employee and employer. It's really nice that these things are well defined. Lump sum choices, and then the tax deferrals. And we're going to talk about some of these things. So this I thought was interesting. And Dr. Rowe, I'll be curious of what you think about this. So when you think about like a 401k plan and its contribution, you are going to, as an employee, you invest money, but you use pre-tax money. So you're not being taxed initially on what you're investing, which means then theoretically you're able to invest a little bit more. The flip side is, when you withdraw, you take the money out at that tax rate where you are.
Mhm.
But there's another interesting aspect of this. There's a reduction in payroll taxes from the employer side because in a 401k, what typically happens is an employee puts in a percentage, and the employer will match that same. And the employer then receives a benefit because the employee is essentially reducing their overall income and they're not paying that additional payroll tax. So they're able to further compensate the employee and still receive a tax benefit. I just think that's amazing.
So, oh no, and I really did not realize, I think everywhere I've worked corporate wise has done some sort of retirement matching. And goodness gracious, I should have matched the max that I could my whole career. I'd be in much better shape if I had done that. But I didn't realize that it's actually tax deductible for companies. They get a tax deduction based on the matching,
And it's
and
interesting
which I think is great. I like when the government encourages people to do
the right
something
thing.
that's right for them, you know?
And that matching plan, and again, this is what makes that defined contribution and that defined benefit different. As a part of your compensation, that can fluctuate. So those
Mhm.
things can change. So an employer might, to reduce cost, might actually reduce that matching rate. Or if they're having a very good year, they might increase their matching. So it's another interesting way that gives companies more flexibility around compensation to the entire, into the employee itself. Okay. One nice thing about the ERISA is it helps uh, receive protection from employers because these are predefined accounts. They're qualified and they are subjected to regulations and that are monitored by the government. So, some of the advantages of these qualified plans is again that ERISA protection. There are some possibilities to get lump sum payments of your plans. For the most part, you're going to have a withdrawal, and we'll talk about that as actually a disadvantage. The availability to use pre-tax contributions. Again, and I want to make the flip side. Dr. Rowe, you remember Keith Black, right?
I do remember Keith Black. The last time I saw Keith Black was in Hong Kong, but I do remember Keith Black.
And one of the things that he would overemphasize when you're thinking about defined contribution is everybody raves about how great it is that you are deferring these taxes. The catch is when you go to retire, you're most likely going to be at a higher tax rate. And that's something a lot of people don't really think about. So, yes, it's great that we're using pre-tax dollars, bullish for that, right? Because we have a greater amount that we can invest in and hopefully grow. But when we go to start withdrawing from it, we'll be using a potentially higher tax rate than where we currently are now. Advantages to employer, it's not subjected to payroll taxes, and the contribution of income then becomes tax deductible. And one thing that's not listed here, and this is just my opinion, I think it's something that's attractive to employees. So if you're looking at two offers and one
What's
has a
that?
qualified plan and one doesn't, the one with a qualified plan would be more attractive. So disadvantages, and
That's
again,
a big slide.
it's a big slide.
Yeah, and there's a reason that everything has shifted from qualified to that there's been a big shift. Go ahead.
Well, and these aren't
Yeah.
even these are basically disadvantages of your 401k.
Yeah. So
And so some of the things that I think if
I see.
these are great problems to have. Let me put it that way. So one of the things that this is a challenge for some seniors, not all, but this idea of mandatory distributions. What if you're in a situation where you don't need that income? So you've been saving, saving, saving. You don't really need to draw on your 401k and start receiving some of those withdrawals. You don't have a choice. You have mandatory
Right.
distribution, right?
And that
Let's,
and sometimes and that creates a taxable situation, does it not?
It does. So let's say that you're
And that,
thinking, I
mm,
just want to bequeath this money to somebody else. I don't want it. I would rather see those assets grow even further. I'll start withdrawing them when I'm 80 as opposed to 65. You don't have that ability. You have mandatory distributions. These are going to be taxed as ordinary income. So most people's highest income levels are the last 3 years of their life, which means you have a higher tax rate. If you want to use the money for something besides simply retirement, you can, but it's going to cost you. It's going to be a penalty for anytime you want to withdraw it early. You might not even have access. So even with early withdrawal, there's very specific things that you can borrow or take out early. Otherwise, it's not allowed to. I think it's like a 25% deduction. So like if you want to
something like
withdraw,
that. It's
it,
ridiculous. It's a really, it's a prohibitive number in my mind.
yes, and which with
Yeah.
the goal to force people to save for retirement.
Hmm.
Um, This is one of my biggest soapbox topics. These plans have limited investment options. And I don't like the word options here. I would rather it say choices, limited investment choices. So if you are thinking, wow, those mutual funds are really sneaky because they charge me too much fees and I get passed on tax distributions, and I'd rather invest in an ETF, well, a lot of times you can't.
Yeah.
And so you have very limited choices, and those choices are going to be determined by human resources who may or may not know a lot about diversification and what types of products should be offered in a 401k. Um, yes, Dr. Rowe.
If you work at a place and you are unhappy with the choices that they're giving you, you say something
Yes,
because it's very possible. And I feel like I'm qualifying everything I'm saying today by I'm not bad mouthing people, but there might, if you're at a relatively small person, there might be somebody in HR that has selected some sort of, retirement plan for the small group of people working together. And they don't really, they've been kind of talked into something by someone who doesn't necessarily have your best interest at heart, just trying to sell them something.
right.
Also, I would pay very close attention to the management fees that are involved in the choices that you have for the 401k.
Yes.
They can be
And
ugly.
the life cycle funds.
Hmm.
Those have become really the very popular vehicles within a 401k. And this should be another video, but this idea that investors aren't capable of making those decisions on their own, and that's unsettling for me.
Yeah,
So there
absolutely.
are a lot of disadvantages of these types of products, but they do help force employees to start saving for retirement. Okay. Um, Qualification requirements, the documentation. We'll talk a little bit about eligibility and coverage. We're not going to talk too much about the plan documentation, although I really do like documenting. So, putting it together, and this would be your plan of what types of assets can go into it, what are the rules around it,
Hmm.
and that's very valuable to read through and have a general working knowledge. And if you're a geek like me, you just enjoy doing it. But that's very different than something that you really have to be incredibly well versed on. So, eligibility, these have to be defined clearly in your plan document. Does the employee have access to start saving? How much are they going to save? What is the plan around it? And when can they start to take money out? So there is like the educational institutions. I didn't realize there are rules around specifically educational retirement plans, which is funny because both Dr. Rowe and I work in this academic industry. And the
Hmm.
idea is that you have to be either 26 years old or you have to wait 1 year to be vested into the program. And I thought, well, that's an interesting thing. And so these defined contribution plans, all of these things, these rules have to be clearly spelled out.
Okay.
Whatever the rule is, it needs to be spelled out. Is there a rule for military spouses? And there might not be,
Mhm.
and that's fine, but it needs to be clearly spelled out that there is not a rule for them. What does it mean to be a part-time employee? Is there ever a scenario where that part-time employee is going to receive retirement benefits? There's lots of different scenarios. And again, the reason why this is being brought up is that all of these scenarios could happen, but whether or not there's any benefits involved needs to be clearly spelled out in that plan document. And if you could see me in my hand gestures, I'm like, it needs to be spelled out in the document
Yeah,
before you sign anything. So our
that's
coverage,
fantastic. Mhm.
what does it mean to these different types of classification of employees? And I thought there is interesting highly compensated employees have their own special section. And this matters because when we're thinking about how do you define benefits for, let's say, a CEO of a company. So this person would be highly compensated. They should have most likely will have a high base salary. They will additionally have a profit sharing plan. And then for a highly compensated employee, do you do a 3% match on their salary for retirement on top of their plan, on top of their profit sharing? So it's one of the reasons why we
Mm.
have these distinctions among different classes. And when we think about the coverage test, these are just different rules about how we can determine how much coverage should be for each type of employee. Another aspect is when is that vesting schedule? And there's either a cliff or a graduated schedule. And a cliff is either it's the big lump sum or a big lump time, and then you are vested, or are you vested at 1% after 1 year, 3% after 5 years, et cetera, et cetera, et cetera. First is you have to be there 20 years and then you are vested at 50%, whatever the formula is. This vesting also needs to be clearly articulated in the plan document. It, it's a legal binding contract between you and the employer, so it's crucial that all of these things are laid out. Again, different ways we can do it is by years of number of service. But an interesting newer trend that's also coming along is those part-time employees,
Hmm.
especially with the push of the gig economy, this idea of a little more flexibility, making sure those types of employees have access to retirement plans will make a employee much more attracted to that employer, especially when you're thinking about those part-time. Um, so our top heavy plans are really thinking about those key employees, those officers, those specific heavier vesting plans. And then we're going to be thinking about how do we really address that subset of employees within the firm. And this I thought was interesting. Our
Yeah.
controlled groups, or how do we aggregate? And this is when we start to have subsidiaries of companies which own other companies. So if a company owns 80% of another company, then you might have different competing defined contribution plans. And so dealing with that aggregation and making sure that those rules are clearly laid out as well. And we've discussed quite a bit about our limitations for defined contribution or compensation versus our defined benefit plans. Yeah, defined benefit plans, which are our pensions. So we could have situations where there is that shortfall, and then it becomes a major challenge, making sure that there's proper funding. Was it Chevrolet that I think they had one employee supporting basically four retired employees because of the challenges of their defined benefit plans. Um, and this is also a unique problem. These are contributions or our maximum contributions. So our covered compensation for those who make up to $350,000 in 2025. And at first, that might sound like a very astronomical large number for salary, but there are, and this gets why we have to spend so much more time discussing things like those executives because they're at a lot of firms are making substantially more than $350,000. And what do you do with those types of employees? And there are rules associated with how much an employee not only can contribute
Hmm.
percentage wise, but there is also a rule for how much physical cash can go into one of these accounts. And again, that idea is if you are an employee that's making more than this, the idea is that employees should take more of the risk themselves and invest in an IRA for themselves. So these are different types of investment vehicles designed for retirement that's not sponsored by the company itself. And with
Cover
that, we
that.
conclude with our discussion of our higher end employees. Woo! If you enjoyed this video, please hit like, and if you haven't already, subscribe. We are available via our website, our YouTube channel, our email. We're both very open to suggestions and helpful feedback and criticism. With that, we thank you so much for joining us. Thank you.